I am Charlie Munger. I am 99 years old. And in those 99 years, the single most valuable thing I've learned is not how to pick winners. It is how to avoid losers. Most people think investing is about being brilliant. They read complex financial models, learn Wall Street jargon, and try to predict whether a stock will go up or down tomorrow. They think the smartest person in the room wins. They're wrong. Warren Buffett and I didn't build Berkshire Hathaway by being the smartest people in the room. The quant traders over at those hedge funds, the PhD mathematicians with IQs that make mine look average. They could run circles around us on a math test, but we beat them because we were less stupid. Let that sink in. Investing isn't a gymnastics competition where the most impressive move wins. It is a survival game. In a casino full of maniacs, fraudsters, and algorithms, if you can consistently avoid doing dumb things, your competitors will destroy themselves one by one, and you'll be the last person standing. That is it. That is the whole secret now. Today, I am going to give you a checklist. 7 rules that serious investors follow religiously, but will never discuss on CNBC. Why won't they discuss them? Because the moment these rules become common knowledge, the edge disappears. This isn't sexy. This isn't a get-rich-quick scheme. But if you can burn these 7 rules into your brain, I promise you won't die broke. Let's go. Rule number 1, and the most foundational of all, is this. Don't be the person who walks face first into the glass door. There is an old piece of farm wisdom that goes, I just want to know where I am going to die, so I never go there. Sounds like a joke. It is actually one of the most profound investing insights I've ever heard. Most people learn the hard way. They believe in the philosophy of learning through personal suffering, that you only really understand risk after you've blown up your own account. This is expensive and unnecessary. Your starting capital is too small, and your lifespan is too short to personally test every way to go bankrupt. Smart investors don't experience disasters. They collect them. They study failures the way a forensic scientist studies a crime scene, methodically, dispassionately, obsessively. They look at the wreckage of companies that were once great, and they say, so that is how you die. Good to know. I will never do that. Let me tell you about the greatest cautionary tale in modern finance. Long-term capital management, LTCM, 1990s. This firm had a dream team lineup, 2 Nobel Prize winning economists, a squadron of the sharpest mathematical minds Wall Street had ever seen. Their collective IQ could have launched a space shuttle. They believed they had cracked the code of the market. They built impossibly complex mathematical models that calculated every micro-arbitrage opportunity with terrifying precision. For a few years, they printed money. These guys thought they were gods. They believed risk itself had been neutralized by their formulas. Then, they made one catastrophically stupid mistake: arrogance. They loaded up on leverage, borrowing astronomical sums, to bet that certain black swan events were too improbable to happen. Then, in 1998, Russia defaulted on its sovereign debt, according to their models. This was a once-in-several-centuries event. It happened in a few months. LTCM, staffed by the most credentialed intellects on earth, lost billions of dollars in weeks. The Federal Reserve had to step in to prevent a global financial contagion. The lesson: intelligence does not fix. Those Nobel laureates, for all their computational firepower, had less common sense than a corner store owner who knows you don't borrow money to gamble, no matter how good your calculator is. This is why you must read history. The 1637 Dutch tulip mania, the 1720 South Sea bubble, the 2000 dot-com collapse, the 2008 financial crisis, the 2022 FTX implosion. The asset classes change. The technology changes. Once it was tulips, now it is tokens. But human stupidity never changes. Greed, fear, herd mentality, arrogance, impatience. These are hardwired into our DNA. History always rhymes. If you don't read history, you have no memory. You'll look at the next hot thing with no context, and you'll mistake a pile of manure for a chocolate cake. So here is my practical advice. Build yourself a disaster library. Stop reading success books. Stop reading How I Made My First Million memoirs. Those are riddled with survivorship bias and hindsight. Instead, read about every major market collapse, every fraudulent fund manager who disappeared with client money, every over-leveraged investor who didn't survive. Read about the GameStop frenzy of 2021 and the retail investors who held bags when the hype died. Collect these case studies like talismans. Paste them mentally above your trading screen. Because the next time you feel the urge to use margin, the next time you want to go all in on a hot tip, the next time you think, this time it is different, those ghost stories will look back at you and say, nothing is different. We made the same bet. This is how it ends. Rule 1. Use other people's failures to protect your own money. Rule number 2 is brutally simple. Warren and I have an iron rule we call the Circle of Competence. It works like this. If you cannot explain in plain English to a smart 12-year-old exactly how a company makes money and why it will still be making that same money 10 years from now, then you don't touch it. Full stop right now. There is a disease spreading through the investing world called FOMO, fear of missing out. You see your neighbor made money on Bitcoin. Your coworker doubled his portfolio on some AI chip company whose name you can barely pronounce. Your confidence collapses. You feel left behind. You feel stupid. So without ever opening a financial statement, without knowing who the CEO is, without understanding whether this company sells software or advertising, you take your life savings and throw it in. That is not investing. That is gambling while blindfolded. Here is something that'll blow your mind. Warren and I missed Amazon. We missed Google. We missed the entire internet revolution. People mock us for it. Buffett and Munger, too old, too slow, didn't see the future. And you know what? They're right that we missed it. Jeff Bezos is a genius. But at the time, I genuinely could not see whether Amazon would beat Walmart. I couldn't confidently model whether they could sustain that growth. I didn't understand it well enough, so I didn't buy it. And I have zero regrets in this game. There is no umpire calling strikes on pitches you don't swing at. The pitcher keeps throwing Tesla, Nvidia, Bitcoin, the next hot thing. These pitches fly in fast, high, enticing. But if they're not in my sweet zone, if the difficulty of catching them is too high, I just rest the bat on my shoulder and watch. I don't care if the crowd boos me for not swinging. What I am waiting for is the slow, fat pitch right over the middle of the plate. Something like Coca-Cola in the late 1980s. A dead simple business, selling the same sugary drink it had been selling for a century, trading at a price that made no sense. That is when you swing with everything you've got. You don't need to hit many pitches in this game. You need to hit a few perfect ones. The people trying to swing at everything end up striking out. Here is a simple test I use, the one-sentence rule. Take out a blank piece of paper and describe the company you are about to buy in one sentence. If you start drawing charts, throwing around jargon like moat, secular tailwinds, multiple expansion, you are lying to yourself. You don't understand it. If you can say, this company sells the same sugary drink to billions of people at a 90% margin, and no competitor has been able to replicate the taste in 100 years. That is a company you understand. And a company you understand is the only kind worth buying. Every dollar you make in territory you don't understand is just setting the table for a bigger loss later. Money made by luck will always be lost by skill, or rather, the lack of it. Rule 3 is about time. If ignorance is the first killer of investors, impatience is the second. Social media has done something genuinely toxic to the way young people think about wealth. You open Instagram and see 20-year-old crypto millionaires in Lamborghinis. You see 25-year-old founders ringing the bell at the New York Stock Exchange. And somewhere in your brain, a timer starts running. You feel like if you haven't built significant wealth by 30, you've failed. This is a statistical illusion, specifically engineered to separate you from your money. The 20-year-old with the Lamborghini is 1 in 10 million. You are not seeing the 9,999,999 people who tried the same thing and lost everything. That anxiety, the desperate need to get rich fast, is the middle class's greatest curse. It makes people buy a stock on Thursday and check it hourly until Friday, hoping to retire next week. If that is your mentality, skip the stock market and go to Las Vegas. At least there you'll get free drinks while you lose. Now, let me give you some math, because math doesn't lie. Compound interest. Einstein reportedly called it the eighth wonder of the world. But compounding has one non-negotiable requirement: time. Say you earn 20% annual returns, already an extraordinary result, better than Berkshire's recent averages. You start with $10,000, after 10 years, $60,000. After 20 years, $380,000. After 30 years, $2,300,000. Impressive. But wait, after 60 years, $566 million. From 10,000 to $500 million. The difference is not intelligence. It is 60 years of boring patience. The growth curve is painfully flat at the start. You are working hard, sacrificing, doing everything right, and your wealth crawls forward like a glacier. Meanwhile, your neighbor is day trading and brags about making 10 grand last week. So you get restless. You sell the good stock that would have made you a millionaire. You chase the momentum names. You shatter the compounding process. And once you break compound interest, you are rolling the snowball back to the bottom of the hill. The French philosopher Pascal once wrote, "All of humanity's problems stem from a person's inability to sit quietly in a room alone." In investing, the equivalent is, most investors' losses come from their inability to do absolutely nothing. Wall Street hates investors like us. We buy a stock and sit on it for 5-10 years without touching it. We don't generate commissions. We don't consume their research reports. We just sit there like statues. But that statue, like stillness, is where the fortune is built. Think of it like planting a tree. The best strategy is to plant it, then go take a long nap. If you dig the roots up every week to check on them, or decide to inject fertilizer every month, because it is not growing fast enough, the tree dies. Extend your time horizon. Stop thinking about how to get rich next year. Think about what kind of life you want in 30 years, and reverse engineer from there. In a world that worships speed, slowness is the ultimate edge. The people who are willing to get rich slowly always do. The people determined to get rich quickly always become cautionary tales. I am going to challenge something you've heard 100 times. Every business school professor, every financial advisor, every television personality will tell you, diversify, diversify, diversify. Spread your eggs across as many baskets as possible. Modern portfolio theory, optimize your Sharpe ratio. I am going to tell you that is mostly nonsense. Or at least, it is the right advice for the wrong reasons. Let me be precise. If you genuinely have no idea what you are doing in markets, then yes, buy an S&P 500 index fund, buy the entire American economy, and go live your life. That is fine. That will protect your money. But if your goal is to build serious wealth to actually beat the market, then diversification is optimization in the wrong direction. Here is something that'll put this in perspective. If you removed our top 5 investments from Berkshire Hathaway's history, our performance would have been perfectly mediocre. That is not a failure. That is the entire point. Extraordinary results don't come from 40 good ideas. They come from 4 or 5 spectacular ones. When you find a company that you are absolutely certain about, something like Apple in 2016 or Coca-Cola in 1988, you don't buy a tasteful 5% position. You load up. You swing with everything you've got. As the saying goes, when it is raining gold, reach for a bucket, not a thimble. Here is a mental model I want to give you. The 20 punch card. Imagine that for your entire investing life, you only get 20 investment decisions. Every time you buy a stock, you punch a hole in the card. When the card is full, you are done. You can never invest again. How would that change your behavior? You'd become intensely selective. You'd never buy something because you heard a ticker in an elevator or saw a hot take on Reddit. You'd research exhaustively. You'd check everything. You'd only commit when you had genuine, high-conviction certainty. Now, look at most retail investors. They have 45 stocks in their portfolio. Healthcare, oil, fintech, meme stocks, a couple of ETFs. They can't even name the CEOs. They've forgotten why they bought half the positions. That is not a portfolio. That is a zoo that got out of control. Inside that zoo, there might be 2 or 3 genuinely great stocks, but their gains are completely diluted by the 40 mediocre ones, dragging the average down. Ask yourself a simple question. If you've already found the single best opportunity you can identify in the world today, why would you give any money to your 10th best idea or your 20th? Is your 20th best idea going to outperform your first? Obviously not. Risk doesn't come from concentration. Risk comes from ignorance. If you truly understand 3 companies, 3 is enough to make you very wealthy. If you don't understand anything, 500 won't save you. Rule 5. This might be the least glamorous rule of the 7, but it might also be the most financially devastating one to ignore. There is a powerful industry whose interests are fundamentally opposed to yours. I call them the house. Brokers, fund managers, financial advisors. They dress well. They speak smoothly. They use impressive words. But none of that changes a simple structural fact. They make money when your capital moves. You make money when your capital grows. You only profit when stocks go up. They profit every time you click buy or sell. So the entire financial media industrial complex is built around one purpose: getting you to trade more. They invent elaborate charts and tell you it is time to rebalance. They publish alarming research reports suggesting you should take profits or cut losses. They're moving chips from your stack to theirs. Let's do the math, because this is genuinely shocking. Suppose you invest $100,000 and earn 7% per year. With 0 fees after 30 years, you have $760,000. Now add a fund manager who charges 1% annually, considered quite reasonable in the industry, plus your own trading activity, generating another 1% in friction costs. Your net return drops from 7% to 5%. After 30 years, $430,000, $760,000 versus $430,000. That invisible one-person fee, amplified by compounding, ate 40% of your lifetime wealth, and we haven't even touched taxes. In most countries, when you sell a stock at a profit, the government takes 20 to 30% of that gain. Every single year you sell, every single year you realize your profits. You hand a large slice to the government before you can reinvest. At Berkshire, our strategy has always been, as long as the business remains excellent, we never sell. Why? Because as long as we don't sell, we owe no capital gains tax. That money, the taxes we'd owe if we sold, stays in our account, continues compounding, continues generating returns. The government effectively gives us interest-free loan of enormous size for decades. That is the hidden mathematical superpower of buy and hold. It is not just philosophy. It is tax engineering. So, fire your financial advisor if they're pushing frequent trades. Shut down the apps that make trading feel like a video game. Reduce your annual transaction count to single digits. Every trade is a toll booth. The fewer you pass through, the more you keep. The best investment we ever made was buying Coca-Cola in 1988 and then completely forgetting about it. 30 plus years, 0 commissions paid, 0 taxes triggered on that position. Every dollar of its growth has been working for us, not for Wall Street. Rule 6. If I had to pick one word to describe the secret to successful investing, it wouldn't be intelligence. It wouldn't be hard work. It would be temperament. Here is the problem. Your brain was not designed for stock markets. It was designed for the African savanna 50,000 years ago, for dodging predators and finding food. This evolutionary history has given you 2 specific cognitive bugs that will kill your portfolio. The first is social proof bias, herd mentality. When everyone around you is buying, your primitive brain screams, join them. The herd knows something you don't. Falling behind the group was fatal on the savannah, but in markets, it is the exact opposite. When every taxi driver and every barber is talking about the same hot stock, when your whole social feed is full of people celebrating their gains, you are not at the beginning of an opportunity. You are at the top of a bubble. You are the last person to the party, right before the cleanup crew arrives. The second bug is loss aversion. The psychological pain of losing $100 is about twice as intense as the pleasure of gaining $100. This is deeply irrational. $100 gained and $100 lost are mathematically identical, but your brain doesn't see it that way. So when your portfolio drops in a crisis like March 2020, when COVID triggered market circuit breakers, your rational mind knows these are great businesses on sale, but your limbic system is screaming, sell, get out, preserve what is left, run. This is why most retail investors buy high and sell low. Not because they're stupid, because they're human. Warren and I have one trait that has served us better than any analytical framework. We are not moved by the crowd. When the world mocks us for missing a tech rally, we're unmoved. When the world is in panic and selling everything, we're unmoved. We evaluate only two things, the facts and the logic. Build your own emotional circuit breaker. When you notice your pulse rising while making an investment decision. When your hand is shaking as you type in a ticker. When you are buying purely because you are afraid of missing out, stop. Go for a walk. Splash cold water on your face. Come back tomorrow. Because at that moment, it is not your rational mind making the decision. It is your amygdala, the scared, ancient part of your brain that has been hijacked by the market's noise. The stock market is not just an intellectual competition. It is a character competition. The most emotionally stable investor in the room will always, over time, take money from everyone else. Rule 7. And this is the most important thing I can say to anyone who is young and just starting out. Don't quit before the magic happens. I often say the first $100,000 is the hardest. However you get there, save aggressively, work an extra job, eliminate every unnecessary expense, get there as fast as you possibly can, because that first 100,000 is the critical threshold. The compounding curve is shaped like a hockey stick. For the first decade, maybe 2 decades, the line is almost flat. You are pushing a boulder uphill. You are sacrificing, investing carefully, staying disciplined, and your wealth grows at a pace that feels almost insulting. This is the moment most people break. They look at their progress and think, why am I doing this? My coworker is spending freely and seems just as fine. My neighbor flipped a house and made more in 3 months than my whole portfolio earned in 3 years. They stop saving. They sell their positions. They leave the game. They quit at dawn. But here is what they miss. Once you push the boulder over the top of the hill, gravity switches sides. It starts rolling on its own. When your portfolio reaches $1 million at 20% annual returns, it is generating $200,000 a year, without you doing anything more than most people's annual salary, just from existing. That is the moment capital stops being something you own and starts being something that works for you. I wasn't born wealthy. I practiced law. I lived modestly. I drove unremarkable cars. I saved every dollar I could and put it to work. I lived through the years when the growth was invisible, when the effort felt disproportionate to the results. I didn't stop. Investing, like life, is a marathon, not a sprint. There is no official who penalizes you for running slowly. The only way to lose is to step off the track. So even if you have only a few $1,000s right now, even if $1 million feels impossibly far away, do not stop. Keep saving. Keep buying good businesses. Keep waiting. As long as you stay in the game, the compounding snowball will eventually find you. So there it is, 7 rules. Let's run through them one final time. Rule 1. Learn from corpses. Study failure obsessively. Don't be the person who personally validates every way to go bankrupt. Rule 2. Stay in your lane. If you can't explain it simply, you don't understand it. And you never invest in what you don't understand. Rule 3. Get rich slowly. Compound interest is the most powerful force in finance, but only if you give it the one thing it demands, time. Rule 4. Concentrate your best ideas. Don't run a zoo of mediocre positions. Find the great ones and go in heavily. Rule 5. Minimize friction costs. Every trade is a tax. Every fee is a leak. The less you move, the more you keep. Rule 6. Master your temperament. The stock market is a machine for transferring wealth from the emotionally reactive to the emotionally disciplined. Rule 7. Don't quit before the magic. The early years are brutal and boring. The later years are spectacular. Most people never get there because they stop in the middle. You'll notice that not one of these 7 rules tells you how to predict the future. Not one of them is a clever trick or a secret shortcut. They all sound deceptively simple, boringly obvious, even, but as my 99 years have taught me, common sense is only called common because it ought to be. In reality, it is exceedingly rare. In a world full of noise, temptation, and manufactured urgency, you don't need to be a genius. You just need this checklist and the discipline to actually follow it. Don't try to do something brilliant. Just avoid being an idiot. The rest takes care of itself.